Welcome now, stock trades. In this video, we're going to go ahead and talk about this crazy stock market crash that we've been experiencing for quite some time. Now, you've been, if I was you right now, I would be like, man, I'm very sick of, tired of all this red that I've been experiencing, and it's just been getting really annoying, right? So, whenever I get like this, I always like to look into the past because obviously, trying to understand what's going on here is not going to do you any good. And many people are trying to essentially read articles and read as many articles as they can find. And what you're going to find is you're really not going to get any answers here. Okay. And I'm speaking from experience. The best course of action is to go into the past, understanding how past market crashes have happened and what essentially were the two fundamental elements that protected investors, right? So we talked about this. So we're going to go ahead and we're going to go back in time. Okay. This book was literally written back in the 30s and 40s. And yes, it applies into today's present value, right? So this is a book called Security Analysis by Benjamin Graham and David Dodd. Yes, the same professor that taught Warren Buffett and all of the disciples of value investors, which we follow, like Bill Ackman and a lot of other folks that essentially do exactly what is in this book. Now, unfortunately, I don't know why many Americans and people around the world, some of them have this book and haven't even read it. And unfortunately, it's a big mistake. So in this book, we're going to go ahead and just cover these 2 pages. That's it. Just these 2 pages. Okay. Now we've already covered the first one, right? So it says here, the first of these is a distinction between investment and speculation. Okay. So this is the first idea. And we've covered this many times. If this is the first time you heard about this, it's okay. Well, here you go. Okay. The first one is an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are deemed speculative. Okay. This is literally the first chapter of The Intelligent Investor by Benjamin Graham. Okay. Now, the question is what is this thorough analysis? What is thorough analysis? What do you need to do to essentially go and analyze and be thorough with your business, right? And this is where the second thing comes in. Okay. So the critical part of this definition are thorough analysis and safety of principal and satisfactory return. Nothing about these requirements has changed since 1934. It's basically saying, literally, everything that was done in Wall Street in the 30s and 40s and 50s, obviously there's been minor changes, but the core base has been the same. To all the doctors that are watching this channel, a sodium level under 130 constitutes hyponatremia, okay? The way we correct those, especially if you get really excessive hyponatremia, is the same, right? And the thorough elements of medicine, there's some minor advancements that change how we practice, but overall, the basis of medicine stays the same. And that applies to this, right? Math stays the same. A 1 doesn't just become a 5 100 years later, okay? So let's go further. A second idea, and this is the idea that unfortunately many Americans and investors all around the world do not understand, sadly, is that it is related to the idea of focusing on intrinsic value of a security, of a stock. It is according to Graham and Dodd that the value which is justified by the facts that the assets, earnings, dividends, and definite prospects as distinct, let us say, from market quotations established by market manipulation or distorted by psychological excesses. I'm going to read that again. That the value which is justified by the facts, the assets, earnings, dividends, and definite prospects as distinct, let us say, from market quotations established by market manipulation or distortion of psychological excesses. So let's be real here. We calculate the value of the stock, but sometimes the value of the stock does not equal the true value, aka what Mr. Market is expressing. And what this is saying is that because the intrinsic value, which is calculable, does not equal the true value of the company being traded at, it is deemed, due to the fact of market manipulation and psychological excess. Now, in the beginning, when we were essentially talking about a particular company, there was a lot of market manipulation, a lot of price target changes and market manipulation that destroyed the mathematical equation between intrinsic value and the true value. And now we're starting to experience something interesting. We're starting to see that the psychological value is now incoherent with the market manipulation, which then does not equal the intrinsic value calculated, because in true essence, an intrinsic value must equal the true value. But you're saying that the economic form is basically, they operate in a way that is true to reality, that is mathematically justified, aka the first chapter and lecture of any economics class you take is the idea and the fallacy that economic movements form in a logical sense. No, they do not. Governments go off of emotion. It doesn't work that way, right? That's not how an economy works. It's emotionally driven. It is manipulated. But overall, cutting to the chase, the intrinsic value in due time will meet its true market expected value. Let's read on. In an ideal world, intrinsic value would be the true value of a security. In today's language, it would be the present discounted value of the expected future free cash flows it generates. Okay? If these expected cash values and an appropriate discount rate could be calculated perfectly from an available facts, then the intrinsic value and true value, aka what the stock is trading at, would be the same. However, Graham and Dodd recognized that this was never possible. Inadequate or incorrect data and the uncertainties of the future meant that intrinsic value would always be an elusive concept. So going back here and going back to discount rate, right? What the hell do we do here? There's the discount rate. There is the sum of discounted future free cash flows. And this is essentially bringing them back into today's present value. Let's read on. Nevertheless, through investigation of intrinsic value was in this view central to any investment process worthy of the name. It serves first of all to organize examination and the use of available information, ensuring that the relevant facts would be brought to bear and irrelevant noise ignored. Okay, so essentially it's telling you ignore the bullshit. Okay, now, second, it would produce an appreciation of the range of uncertainty associated with any particular intrinsic value calculation. Now, again, there's a lot of English here that doesn't make sense. I will make it sense for you. Don't worry. Okay, that's why I'm here. Okay, Graham and Dodd recognize that even a very imperfect intrinsic value would be useful in making investment decisions. In their words, this is their words. It needs only to establish that the value is adequate to protect a bond or justify a stock purchase, or else that the value is considerably higher or considerably lower than the market price. And the degree of the indistinctionness may be expressed by a very hypothetical range of approximate value, which would grow wider as the uncertainty of the picture increased. And this is a great explanation to what that basically is trying to say. The purchase of a security. So essentially what he's talking about is margin of safety. Okay. I know it's very difficult they don't call it that, but that's what it is. Okay. So the picture of securities should then be made, and I'll explain all this right now, only at prices far below the intrinsic value to provide a margin of safety. Essentially, when you calculate the intrinsic value of a company, you typically, if you want to be even to protect yourself, go below the intrinsic value of the company. And we talked about this in this video here. We talked about it. We calculate the intrinsic value of the company And if the company's trading here and the value is here, obviously it's overvalued. And if the company is essentially trading here and the intrinsic value is here, then it's undervalued. But if you want, you can take the intrinsic value and create a 20 to 30% margin of safety. And that margin of safety equates to your buy zone. And that essentially limits you just in case of the intrinsic value changes or the economic forms within the business starts changing the fundamentals. I hope this makes sense. Let's continue. So in essence, what Graham and Dodd required was that an investor, as opposed to a speculator, should know as far as possible the value of any security purchased and also the degree of uncertainty attached to that value. An investment would be made only at a price that provided a sufficient margin of safety to compensate for the uncertainty involved. As a prescription for obtaining protection of principal and a satisfactory return, this approach has obvious advantages over almost any conceivable alternative. This is exactly what it takes to become an intelligent investor. These are only two pages out of 800 pages, okay? And what we did is we've done so much, my many years in this crazy market, we've taken this and we essentially inputted it within these calculations here, trying to take the lessons from Benjamin Graham and David Dodd, Warren Buffett, and all of the greatest investors of our time to create something to where we can actually physically create and calculate the intrinsic value of a company, let alone once we calculate the value of the company, imagine what would be the margin of safety when that company falls down below so equivocally. What would be the buy zone? Long story short, investing is not for anyone. It is honestly half of the battle, a psychological one. So this is going to be very interesting to see how the next 3 to 4 years play out. And I want you to pay attention to the comments other investors, or more specifically, speculators, are making. So I hope this was an educational video. I hope that this helped. And I'm going to go ahead and read these comments here. And we're going to go in and respond to them appropriately. I took a screenshot here, and just in case if I lose them, and I'll go ahead and read them. Okay. All right, guys. It's always a privilege and honor to help you guys, and I'll see you on the next one. And just very clear, you cannot find answers here. You got to go back in the past. Most people don't like to go back in the past. I don't know why, but they always like to live in the present, and unfortunately, that's how they get you. So I don't like to look at here. I don't do that. Okay. All right. See ya.